Welcome to the Dividend Talk podcast, episode 65, a short review on ABB Ltd. Hey guys, welcome back to another episode of Dividend Talk. This week, myself and European DGI will talk a little bit about the news. We're going to review ABB Ltd in detail, and then we'll look at some portfolios and answer some questions from the community. If you don't already do so, please follow us on any of the social media platforms such as Facebook and Twitter, and follow us on Spotify and YouTube. See you on the inside. Good morning, European DGI. How are you today?
Finally weekend, right? We chatted a little bit before, but I think we're both wasted at work. Long days, lots of hours. September has started with a lot of workload, but I must say for me it's quite exciting at work. We have quite some nice stuff to do, but it puts some pressure, of course, on our other hobbies and passions like this podcast, for instance. But yeah, good having you again today.
Yeah, quite similar. Apart from the excitement part, we're under pressure behind deadlines. But as you said, we're recording this Saturday morning as opposed to a Friday night, so trying to fit this in has been tough. But we do it every week. We schedule it in, so I'm quite looking forward to it. But hey, let's just maybe jump into the news of the week. I see there's two items there that may interest our listeners.
Yeah, what I found really interesting is that Picnic, which is an online grocery store in the Netherlands, has raised 600 million euro from investors like Bill Gates, the Bill and Melinda Gates Foundation, in the next funding round. Why this one is so interesting? Because I'm a big fan of Ahold Delhaize, and I love also their online business component. But if there's one challenger to their business model, it's Picnic, because they don't own physical stores. They only have distribution hubs and deliver directly to the customers. So this whole business is set up and geared towards fast delivery with good groceries. I know they don't have many specialty products or something like that, but they're gaining a lot of market share quite quickly. So it's you need to know your enemies from that point of view, and Picnic is one when it comes to the disruption of Ahold's business model in the long term, specifically when it comes to the Dutch sales. And they raised money, 600 million, because they want to expand into Germany and France. So they really want to start going further into Europe. So I've got two feelings there. As a Dutch citizen, I'm really proud that such an innovative business is doing well. But on the other hand, need to keep an eye on them that they don't eat away my dividends from Ahold Delhaize. And I found it really interesting that the Bill and Melinda Gates Foundation also stepped in here.
Yeah, that's the bit that's quite interesting. And I don't know what influence those guys have. They normally invest in companies where, I mean, they obviously see some sort of potential there. Like you, I'm an Ahold shareholder, so my feelings here is, okay, I need to check out this Picnic guy. If they are growing fast, if they're grabbing market share quickly, it might be good to own a little bit of those while they're in this growth phase. But I'd like to know what the Gates Foundation involvement is and what their record is while investing in companies growing like this as well. I'm sure this is not the first and not the last, but I'm not quite sure how they've performed in the past or what influence they hold over it.
Well, I can only tell you that you need to have a little bit more cash than you have now to be able to invest in Picnic, because you need to be part of such a founding round, which makes it a bit harder. But interesting company to keep an eye on, and if ever possible, bet on two horses, right? You don't need to take only a single one and put all your money in one bucket. But the next one is again a little bit based on Netherlands. I guess I have some Dutch bias there, but I found this one really interesting because we saw this also in the UK before, because Uber drivers are now considered employees by the Dutch court. And this I find really interesting because it is all about the gig economy. And what we see more and more, because not Uber is not the first company here, that the gig economy is not being accepted, not even just by local governments, but even by the rule of law. So because what we have seen, of course, a lot is that it benefits two parts. It benefits a company like Uber because they don't have all the costs related to an employee, and it benefits an individual because they can quickly make a buck if they want to. But it's all quite short-term sighted, and it doesn't really, from that point of view, potentially give the contribution to society as well. When you think about the things we pay as normal employees, let's say.
Yeah.
So, but on the other end, for me, always this gig economy also feels like a race to the bottom. So the rich win and the poor get poorer in the long run. So I've got some mixed feelings here. From one side, I really appreciate the entrepreneurship here, and that anyone can start a business quite quickly and just put an app in their car and start earning money. On the other end, it's really a race to the bottom. So I guess I'm on the favorable side of what the Dutch court was saying when it comes to the overall impact of the economy, to put some protection around this for employees and give them also more rights than only duties.
Yeah, I know. I agree 100% with that. I mean, you spoke about the UK, and I know Sports Direct had a huge court order, and they were giving 0 contract hours and making employees contractors just to benefit themselves. I know I had a small business for a long time, and I play because I was small, but I placed so much emphasis on employees and their rights and making sure that they were okay, that I really hate when big companies come in and just take advantage of people, because at the end of the day, people are just trying to make a living, and sometimes they might see, okay, with Uber it's slightly different. They might be doing that part-time. Okay, they might have a job, and Uber is something you can do part-time in the evenings or in the nights. But if they have to do that, it's for a reason, isn't it? I mean, they're not going to be financially sound, or they have financial pressures that they need. So it's kind of like taking advantage of these people. They're happy to make a quick buck, but they have 0 protection, and probably
exactly
when they need it the most is when it gets pulled from them. And so
that was during the pandemic, right?
Yeah.
Many Uber drivers switched work during the pandemic.
Exactly.
If nobody ordered something, they were without food, effectively.
Yeah. So I mean, I 100% agree with the Dutch court here, and I'm glad to see it happen. I know Uber will have added expenses, but I mean, people are people at the end of the day, and I'll always choose people over companies.
Yeah, same here. And I think this is the European flavor that we're always talking about. Okay, so interesting stuff. We'll keep an eye on how that develops going forward. But let's get into the main topic of today, a stock review about ABB. I think it's a company that specifically you could be familiar with. I think it's really a company that many engineers know. So could you talk a little bit or introduce the company to us for maybe the non-engineering people?
Yeah, so I was a little bit surprised with these, actually. I remember ABB as power grids growing up, and I think a lot of people will associate them with power grids, transformers, and all these big industrial electrical components. Surprisingly, I haven't really looked into them as an investment point of view before. I've spoke with Declining Capitalist. I may be writing about this, so I'm glad this came up. But they're starting to move away from power grids and moving into a more, how would you say, future digital age. So we'll speak a little bit later about their business model, but their main business units is electrification products, robots and discrete automation, and motion and industrial automation. So electrification is basically, we talk about medium voltage products and solutions. So they can, something easy to understand there would be, say, like chargers for electric vehicles and stuff like that. So that's what we're talking about, medium voltage solutions, something like that. Robotics and automation is quite simple. It's robotics. We know, like, robot arms. They're starting to go into the mobile world, not particularly cars, but more so like mobile automated forklifts, or small robots that carry things to people or carry things to units and stuff like that. And then you got your motion and industrial automation, which is more so for me, which would be motors, sensors on motors, and gathering data on those motors to make them better, to see like, like for preventive maintenance, to are they going to go? When are they going to go? When do we need to replace them and stuff like that? So, I mean, they're fully integrated in this electrical world. They're moving away from the old style power grids, which is really, really good. But anywhere you look outside, you're going to see electric charging stations. You're going to see robots. You'll probably see robots in shops in the future. And ABB are probably one of the leaders in all those segments. So I think in each of those segments, they'll be either top 2 or 3 in all of those.
What I found really interesting, and what also to your point, we did Siemens one time before here, right, on the
Yeah.
show as one of the episodes. And when I see what ABB is transforming into as a company, it's like really lookalike to Siemens. So I think Siemens and ABB will be really the 2 strong competitors in this world when it comes to new energy and electrification. Because, for instance, we saw at Siemens building trains, electrical trains and such. Here it's also about e-mobility. So I think they might even use their own components in some of their products or each other's components.
Yeah.
But I think these will be the 2 big players in this area when we think about it from a European point of view. But why I like to also talk about ABB on this show, because ABB is a company also operate out of Switzerland, and they have quite a long dividend history already. And if you go to their website, you can see that it easily already traces back to 2006 when it was still paying a 24 cents Swiss franc in dividend, and nowadays it pays a 80 Swiss franc per dividend. It has never been cut, although the last 3 years the dividend remained flat, and a lot to do has with the divestments that they have been doing, like you mentioned, also with the power grids, but also of course the pandemic on top of that. So they've been heavily divesting, and I think it makes an interesting case also to look at it, whether this is now a company that we would like to own. It has a 2.42% dividend yield. I know when people think about Swiss companies with a 35% tax rate, they straight away shy away from it. We can reclaim taxes. We also heard from David Frank how easy it is for German people to reclaim taxes from Switzerland. So I think it's really a nice case for us to discuss for such a, well, let's say, I would still say high quality company. But the question then is it also a high quality stock, right? And what I wanted to also mention here is if we look at the business units now, you mentioned them already, electrification and moving away from power grids. It is really clear, because if you go to the website and you go to the latest Capital Markets Day, you can clearly see that they expect a revenue growth of 3 to 5% going forward, depending or on average through every economic cycle. But you can clearly see that electrification and the motion here are the high margin businesses, unlike, for instance, process automation or something like that. We see that back really in their operational EBITDA distribution, and even if it comes to allocation of resources like employees, it's really interesting that motion is one of the smaller business units in employees, but is one of the bigger in profitability. And this is what we like, right? As little resources and as much as profit on top of that. And with that, they expect also to continue growing EPS. But what is even more nice is that they want to return all the or most of the cash that they receive from selling the power grid business, which is approximately 7.5 billion, back to the shareholders. And as per their latest quarterly 2 report, half year results, they launched a buyback of 4.3 billion. Buyback program, which at the current share price is a 6.3 buyback yield. Wow. So if you put this together with the dividend, you're talking about an 8.5% shareholder return at the moment for the upcoming, let's say, 1 to 2 years, which is enormous, right? If you take the buybacks also into consideration. And the buybacks make sense if you think about it from a profitability point of view, because they're currently at a PE of around 14. So it's not like it's trading at 35 or something like the PE.
Yeah, I mean, you mentioned some of the electrification has been their biggest revenue growth. What was surprising was that robotics was the lowest, but I think that has probably the most growth potential, particularly as we see populations getting bigger. We're seeing shortage employees, particularly actually in the automation world. I know in my field, actually, like, it's really hard to get people, and you could probably train robots to do some things. We might start seeing it in shops and takeaways and all these low value jobs, or even repetitive jobs as well. And also from a geographical point of view, in that sector, I mean, China, as we expect, is quite high, but US are lagging surprisingly quite a lot behind them. So there's lots and lots of growth potential, I feel, in the robotics and discrete automation. It's probably, as you can tell, an area that I work in a little bit more. So I'm a little bit more happy in this world, but I feel like there's plenty of growth in this company. And when I look back at the revenue, and I suppose this is why it's important to have a forward-looking perspective on companies, because I'm looking at the figures. I've pulled the figures from Ticker, so I have a spreadsheet where I pull the figures from and input it in. And if I was to look at this company just based on that, I would not be overly excited about this company, because I mean, the revenues haven't been growing. In fact, they've been slightly declining over the last 10 years, and straight away that would cause a red flag for me. But then when you look at how they're actually transitioning, you would expect some sort of decline. They're moving into newer technology, into space that's not fully mature. So there's plenty of growth there to have. And to your point on the dividend, yes, it's growing. I myself don't like investing in Swiss companies because of the tax rate, but you can also invest in these as an ADR, which obviously has the currency risk, but you get away from that. If you look at the dividend from that, it looks a little bit worse than the Swiss franc. It doesn't grow because obviously the currency rate fluctuations impacts that, but it is an option for investors.
Yeah, and this is also, to your point, we need to study these companies because the revenue decline is also just because of spinning off businesses, right? And it's really simple as that. So it doesn't tell the whole story when only looking at the figures, and that's also how we looked at it when we prepared for the show, right?
Yeah.
And you see it back in the earnings. The earnings per share have not been really stable over the last few years, while it is transitioning and spinning off and such. But it is buying back shares in the last 2 years by the money they receive from the businesses. So this puts kind of a floor also under the share price to a certain amount. So I'm not saying that if it trades today at 33 Swiss franc, that the floor is 33 Swiss franc, but it's unlikely to decline so fast, because then the buyback will eat up a lot of the decline, which is good for us as shareholders, I would say. What I did see is also now with all these spin-offs that the tax rate is really high. I think the last tax rate was around 40%, which is insanely high. They expect it to be around in the low mid-20s going forward. So I think there's some potential there. But if you look at just some Buffett indicators like return on equity, it has always been above 10%, usually hovering around 15%. These are high numbers, right, for a boring business like ABB. We see it also back in the interest coverage. It's almost touching a factor 10. They just have a good business balance sheet here. So they have a strong balance sheet. They can afford buying back all these shares. They don't really need to pay down debt. Yeah, I think they have a debt to equity of less than 50% here. They're also the return on investment. Return on invested capital numbers are really good, also all above 10%, above the cost of capital. So from a capital allocation point of view, this company is doing pretty well. From a free cash flow point of view, it's really hard to analyze the company. Let's say like that. With all these movements in their portfolio, it's cruised up a little bit. What I can only say is when you look at the free cash flow as such, in the last 2 years it was high, but it was also because of positive working capital management things. So we have seen with many companies during the pandemic, they just delayed, for instance, certain things like paying out invoices or something like that. Didn't buy necessarily lots of new inventory, sometimes by design, sometimes because the supply chain was impacted in the pandemic. But all these kinds of things boost up the free cash flow because there's less cash going out of the company, and you retain the cash, right, that you usually would spend. So it looks much better from a free cash flow point of view. So I wouldn't look at the last free cash flow numbers as kind of and derive your future cash flow potential out of that. So I would really work with around, let's say, 1.5 billion of free cash flow if you want to use these numbers going forward.
Okay, and how about that balance sheet then? So look, we know they have good future prospects, but the last 10 years have been kind of up and down over the last 10 years in terms of revenue, earnings, and cash flow. So surely that has impacted their balance sheet somehow.
Well, I don't really necessarily see it because their retained earnings have been flat over those years, and actually in the last year they grew quite a bit. So it means like that more cash left to the balance sheet. Although their their total balance sheet has shrunk a little bit, but stockholder equity has been growing. Debt was 4 years ago 6.7 billion, and it's now 4.8 billion. So I actually see that they have been strengthening their balance sheet over time. They have also a cash position of around 5 billion. So they've been managing the balance sheet really well, and the proceeds of the divestitures of the low margin businesses, let's say like power grids, they're using that to maintain a strong balance sheet, but at the same time also just buy back shares. So I think they have a really good balance sheet, what you expect from Swiss people generally. They know how to manage money. So the fluctuations are really in the earnings at the moment, but they can easily carry this, in my opinion.
Yeah. So it's a well managed company in that regard. I mean, they've been going through a huge. It's no minor transition. It's a huge transition that they are doing, divesting all their old power grids, having a little bit of a choppy performance while still maintaining a strong balance sheet, which is quite respectable and something a lot of our American companies could maybe look to for an example. But
Yeah.
I mean, I'm completely impressed with this company. The figures don't tell the full story, but their potential growth and their management is enough for me. And also they do have a commitment to they like to say this in Europe, don't they? But a sustainable and rising dividend. So
Yeah.
that basically means, look, we're not going to increase it every year. We will increase it when we have enough money to increase it. But I like that. I like that. I'd rather that than borrowing to pay the dividend or forcing it when you don't have it. So
Yeah, and they're not. They don't say here like a 30 or 40% out of earnings, which means for them what they're really saying, we're not going to cut the dividend. That's our intention, right?
Yeah.
And what I like also about it, I think if you let's say like that. Now I don't own shares in ABB at the moment. Why I find it interesting is because it's not just the dividend yield, but if you just look at the PE and such, and if you would also do a discounted cash flow, I find the company at this moment in around fair value. But then on top of that, you get the share buyback. So if you think about it like that, you get already an 8% shareholder return on this company right now by buying the shares. And then you still have, for instance, the order intake change compared to last year is a growth of 11% as an example. So the company has wind in the sails now with all these divestitures. So I find it actually quite attractive to maybe consider initiating a really small position in it. So to start monitoring the company going forward and to see if they really deliver on their commitments and build some trust and understanding of it. That's kind of my thinking, because the buyback yield is really interesting here.
Yeah. Nice. Okay, so look, that was a quick kind of as detailed as we can in a short amount of time overview of ABB. Would love to know, obviously, all other investors' thoughts on this. Anyone that is invested in them, maybe something that we've missed, maybe some risks that we are omitting as well. So please let us know. Drop it in the show notes. Drop it on Twitter, Facebook. We'd love to hear.
Great. So then let's go to the next section of this podcast, and it's the portfolio review. And I can tell you it's becoming more and more interesting, popular, because people are reaching out if they can have their portfolio reviewed as well. So we have a small backlog. I think we have still 3-4 people to go. So if you're interested to have your portfolio also reviewed, drop us a note on Facebook. You will find in the Facebook group, you will find a post about it, and just add your portfolio and we'll pick it up, or just put a new message in there and we'll see it. From that point of view, Martijn Hoek, he asked us to give our opinion about his portfolio. And his 5 holdings are, first of all, 12.2% in the Vanguard S&P 500, then 8.7% in Unilever, 6.3% in 3M, 5.8% in Microsoft, and 5.7% in Johnson & Johnson. He doesn't really see himself becoming financial independent based on the age and the investments that he can make, but he's hoping that, for instance, a certain age like 55, he can work half-time, like 20 hours a week. What is also good to know, below the top 5, he has also some high yielders like Altria, Shell, Iron Mountain, Enbridge, and Verizon to have also some current dividend income.
Honestly, when I saw this, I was super impressed. I'm assuming he's Dutch or around that area, based on the name, and it just reminded me of you. He's just focusing on top quality companies. Like every single one of those companies in his top 5, apart from the ETF, the other 4 we both own. But the fact that they are his top 5 companies just shows what he is truly focusing on right now. Even though he's still in the accumulation phase, he's investing monthly. He's obviously putting a fair share into that every month, while also investing in high yielders, which I think is a great strategy as well. Having 5 core and then having 5 high yielders underneath that, so that there's a margin of safety there, isn't there? There's a little bit added risk with the high yield, but even if you look at the companies in there, you've got Iron Mountain, Enbridge, Altria, and Shell. I don't believe any of them are a risk. To be fair, we know we've got pressures on Altria, because by nature they're a tobacco stock. But Shell, we've given our opinion on them millions of times. Iron Mountain are a company that lots of companies need. You need to store information. They're also moving digital now as well, so there's plenty of room for growth there. Enbridge, I'm not overly familiar, and I know you're a little bit more familiar in them, but they, by all accounts, they seem to be a great company. I think that's Verizon. I'm not sure with the spelling. They're the only one maybe I have as well. They've got huge amount of debt, so they might be a risk as well. But I mean, that's just a top quality portfolio.
Yeah, same here.
In my
Same
opinion.
here. And what I really like is that his core is an ETF. Yeah, 12% in an ETF. I know you have more capital appreciation risk here. As a dividend investor, I said you depend on that, but dollar cost averaging in that, I think also over the long term will, if you believe in the American economy over the long term, this will do you really well, having that. And I think that's something that I'm missing in my portfolio, an ETF, just a core ETF that provides also certain stability here. I'm missing that a little bit, and sometimes I'm thinking about it in a downturn. I might actually buy some dividend appreciating ETFs. At the moment, I find them just too highly valued. But yeah, Martijn, I mean, there's really nothing that I would say different than EMF. This is a top-notch portfolio, really core, and I think you will do really, really well with this. For all of these, like Unilever, 3M, Microsoft, Johnson & Johnson, I find the dividend very, very safe. Even though I know there is some more news lately around Unilever about active investors, maybe or hedge funds that say there's so much untapped value in there. But just that message for me is bullish, because it means like if they really start to focus more on shareholders instead of their stakeholders, what Unilever chose, there's just way more upside, I think.
Yeah.
So very, very sleep well at night portfolio, I would say, from what I've seen.
100%. The only criticism, it's not even criticism, but I don't like to be positive all the time. There's not enough European companies.
Yes.
Unilever's the only one. But no, honestly, that's a portfolio that you take from a textbook, isn't it? It's
yeah, exactly. Well, Martijn, maybe one time you should teach us the other way around. So let us know any recommendations that you have for us as well. We're impressed. Okay, so with that, let's go to the listeners' questions. And Phil is back with his first question, and he is asking us, what do you hate more, paying fees or paying taxes?
Ooh, I tell you what, I don't mind paying taxes if it goes to what it's supposed to go to. So, for example, we have a property tax here in Ireland, okay, and the idea of paying this property tax, like you pay this property tax because you own a house. Okay, I hate it, right? But what it's supposed to do, it's supposed to take your money, it's supposed to go to your local government, and it's supposed to make improvements around. What actually happens is they take that money, it goes into not the local government, it goes into the actual government, and we don't see the benefit of that at all. That I don't like, okay? But I do understand that we have to pay taxes, we have hospitals, we have roads, we have unemployment, we have all this sort of thing. So I honestly don't mind paying taxes. Fees, on the other hand, it depends how high they are. I understand for a service you need to pay a small amount, but if they take the piss, I hate paying fees. So that's why we like the Hero and also maybe IBRK. They've got low fees. If I was to go with an Irish stockbroker, for example, Davies, I'm paying like maybe 10% fees. So why?
Insane.
I mean, that pisses me off. So if I was to ask which one do I hate paying more, I'll say fees. But I really don't mind paying once I get value for them.
Well, at least you have control over the fees and not over your taxes, and to some large extent.
Well, we're talking legal or illegally.
Okay, next question. The next question is from Kasper
Joking.
Kornak. Hi guys, my question for this week is, have you ever considered adding to your portfolio some companies that will benefit from Biden's infrastructure plan like Holcim, CRH, other building materials businesses or railways? I'll answer this question. No, I haven't considered in that. The simple fact is that those are companies, how to say it, I don't like to connect my investment strategy to one-term presidents or two-term presidents. I'm in it for the long way. So if I would be a value investor, I might consider such investment, thinking like, okay, they will get a boost in profits over the next years. Probably the story in the stock market is you should buy them, just ride the wave, and then sell them once they become overvalued. Other than that, I don't follow politicians unless there's, for instance, a change in law, which is really like for decades to come. For instance, think about the climate agreement in Paris, these kinds of things.
Yeah.
Then you can say, okay, I'm going to double down on sustainable energy. But I'm not connecting my investment strategy to single presidents. Yes, with Trump as well, you could have made some quick bucks on a bit when they started building a wall. There was a lot of price appreciation for such companies that had the cement as example. But I'm not such kind of investor, Kasper. So that's why not.
Okay. So we got a question from Claudius, and he has asked us if we haven't already answered. He'd like to know about our asset allocation, and do we guys diversify only in stocks, or do you own anything else? We do a quarterly segment where we do a portfolio review, and we give out our asset allocation in that. Personally, myself, I only have stocks at the moment. I'm looking at other options. I'm looking at CEFs, so they're closed-ended funds and so on. So they are higher income assets, but at the moment it's just stocks. I'd love to get into real estate. I've spoke about that before, but prices are so high here in Ireland that that's not going to happen anytime soon.
Yeah, so I've got two other assets. It's our house, but it doesn't generate any passive income, only costs. And the second one is my wife. She has, she's appreciating still by the year, which is good. Low maintenance, which is also good. And at the same time, she is generating quite some passive income for me when you think about it. So I would say, like you always say, happy wife, happy life. But if they have a job and a career and they become more attractive and beautiful and sweeter by the year, what do you want more in life?
Damn. Hey, I'm not letting my wife listen to this. She'd be like, why did European DGI say that first and you didn't say it? So I'm keeping away from this episode. That's a great answer.
Okay, the next one is from Billy Pritchard, and he is asking us how we would recommend building a dividend growth portfolio when you're starting with small amounts, let's say $500 per month. Would you just buy for that amount, so for $500 per month, a stock that seems like a great value at the time, each month, or wait 2 to 3 years and buy a big make a big acquisition?
Hey, that's how I started, and I always thought about that whether I should wait 2 or 3 years. But you know what? I'm glad I didn't, because it helps you to build that discipline, that you carry forward. It's not, no, relative to each situation, but in global terms, it's not a large amount of money. So I'm sure if you're to make a mistake with €500, it's not the end of the world. But um, I started with €50 a week. I put it up to €150 a month, and so on until I progress. So there's nothing wrong with it. Small or big, it doesn't matter. It all adds up. So I would say just get started. Just invest it. Maybe keep your fees low. That's probably the most important message I can give you when having a small amount every month. Is you want to minimize those fees to maximize what you want to get in return. So I wouldn't wait, because chances are you'll end up spending that on some other shite. So I would probably just start.
Yeah, a good one. I think what you're talking about is dollar cost averaging. Take the learnings. You can better make a mistake on a small amount than on a huge amount.
Yeah.
Okay, so the next question is from Peter, and it's a complex question. I mean, it's a simple question from him, but complex to answer, because he's asking about the Realty Income VRight merger, and that after the merger they will create a taxable spin-off of the office properties. So the question is, should you sell your shares before the spin-off and buy them back afterwards to avoid taxation, and potentially again in Belgium? So Peter, I really like this question. What I can tell you, just I'm not a legal expert in this. I've read up on this stuff. It's still too complicated for me. So I can tell you what I'm doing. I'm just holding on it and take the tax on the chin. These are small amounts for me. We're talking probably about double-digit numbers, like $20 or $30. It's not something where I want to go in and out too much for it. I just take it on the chin. If this would be like, if I would like have $100,000 investment in Realty Income, it might be different. But then again, in Poland here, you need to think about capital gain tax, which is 20%. So if your Realty Income, for instance, doubled over time, the tax impact there becomes also really expensive. And so I don't know really the Belgium tax situation as such. But on these small amounts, I prefer to not think too much about the tax and not make it too complicated to me, because I might also make mistakes. So I'm rather than on the passive end here.
One piece of good news is the Gyro, you can now buy Realty Income again. So thank you.
Yeah, one piece of bad news there. They are charging you 30% dividend tax.
Did not know that.
I can see it because I saw Realty Income again, 30% off. I saw it on Omega Healthcare. So yeah, you can buy it again, but your tax are not adjusted according to the tax treaties. So I still need to follow up on that.
Cool. Keep me posted.
Yes.
Okay, so Dividend Wave has asked us, any of the increases announced during the week look surprising, better, or worse?
I'm just really happy with the Microsoft increase of 11%. It was actually exactly according to expectation. And for me, it's becoming a real compounder. I've got almost a 5% yield on cost at the moment on Microsoft.
Wow.
So people tell me it's not a dividend stock. It is for me. I can imagine if you invest today with the low yield, you might see it as a growth stock. But I bought it 5 years ago as a dividend stock, and it has been doing me much better than I even could imagine at the time. So my net dividend income, so the hard cash, is growing at a really nice compounding rate. So I'm really happy with what Microsoft is doing. Yeah.
Nice. Okay. Centrino has asked us, when you receive a dividend, how do you decide if you reinvest it in the same stock or to another? I mean, I don't know. I just make a decision at the time. So some companies, their dividend is so small, I can't reinvest it in the same stock. I can't buy partial stocks. So I normally just, when I get dividends at the end of the month, I leave it there. I add in my fresh capital and I just buy whatever I'm buying. So I don't particularly plan on reinvesting or not. I just, whatever I'm buying at the time, that money gets added to it.
Yeah. So I can only buy stocks automatically and reinvest that at my Dutch broker, which is there for only also in Dutch companies, which is maybe 10 to 15% of my portfolio amount. I've turned it on there, so I don't need to think about it. It has done me well. I think it never hurts buying back some stocks into Ahold. And on trading 212, I've got automatic reinvest turned on, but I'm using their Pi to invest monthly in the Noble 30 index. So that also goes automatically. But other than that, if I really had to make a binary decision, I would collect the money and reinvest it in undervalued dividend growth stocks.
Okay, and Tiago has asked me a question. Since I'm still living here in Ireland, when I hit my fire number, would I consider moving to a country with a sunnier disposition, both in terms of weather and tax benefits? Honestly, I would probably do that now if I had a choice. My wife is more. She loves Ireland. She loves being around her family a little bit more. But certainly, when the kids are growing up, it is something that we are looking at. I would love to move to Australia, for example. I need warm weather. I need warm weather. I'm going on. I told you this, European DGI. I'm going to Spain on a little holiday for a couple of days just to get some warm weather in a couple of weeks. So I certainly would. Whether my wife will or not, it will depend. And we're a team, so whatever she says wins.
Super. Next question, really quickly from Dermot. Any interest in Sanofi at this price? I can tell you, yes, I have an interest there. It might actually be on my watch list for October. I'm almost done with my purchases in September, so not too much money left for what I still want to spend this month. But I find this, I keep continue getting back to this company, just never pulled the trigger yet. What I don't like is that they have one of the worst pipelines compared to all the other major pharmaceutical companies. So that's still a bit of a concern to me, but that's maybe also why they are more attractively valued at the moment.
Good. Okay, we do have one more question, but I think we might leave that because I think it will be answered in the next segment. So this week we have a stock pick of the week, and I believe you have the honors.
Yeah, it's about Rio Tinto. It's my stock pick of the week. I bought it at 5.2 pounds per share. It dropped straight away 10% after that. That's usually how it goes with me. But the company has a really high dividend yield, about 7% at the moment. Iron ore prices have been dropping. That's why the share price has been dropping, because that's what they get the majority of their revenues from. I am long-term bullish on iron ore. From that point of view, I think the world needs more of this stuff with all what's going on, and on top of that, they have a really nice, good balance sheet. They have a debt to equity of around 25%. Cash flow is strong. Earnings per share are strong. So I find it a really interesting company. They have a 5-year compounded annual growth rate of dividends of 20.5% through the pandemic, and also after the 2016 energy crisis. So yes, I understand we are kind of at what people might think around the peak of this, and that's why they have these strong cash flows. But actually, I think that their dividend is safe because they have a 24% free cash flow payout ratio. So if the cash flow would drop by half, they would still be at half payout. So I don't see how the company would not be able to meet its obligation to the shareholders in the case of dividends. I think we might not see bonus dividends at that moment in time, which have been really large over the last few years. So I saw this 10% drop actually as a consideration to maybe buy something more in October again. So I hope it keeps on falling. I made my entry position, and I find Rio Tinto an attractive company when you think about all the overvalued growth stocks that we have around here. I think it's a nice time to add some materials to my portfolio besides BHP Billiton. So I'm not betting on one here. I'm betting on both. And both have been, BHP Billiton over the last 6 years have been giving me enormous dividends, and which I reinvested in nice other companies. So Rio Tinto for me this week.
Nice. And that was a question from Bas Erlings as well about our thoughts on Rio Tinto. So I hope that answers your question. Nice pick, nice company as well. So no, Nice review. Thank you.
Hey, this brings us to the end of the show again. It went quick. Thanks, EMF. Like always, I really enjoyed it. Don't work too hard. We need to play harder, also on the podcast. So just have a great week and lots of richness with your investments.
Thank you. And again, to our listeners, please follow us on Twitter and Facebook. So Facebook community is starting to grow, and we are interacting with that also a little bit more often. So please jump over, hit us a like, and we will see you soon.